Stop looking at the charts. The charts are barely telling you half the story. We have spent the last 72 hours analyzing the chaos. We have tracked the flash crashes, the dealer shortages, and the arbitrage gaps blowing out between New York and Shanghai. These are the symptoms of a broken market. They are the violent tremors of a financial system that is coming apart at the seams. But while the traders were screaming at their screens in Chicago, and while the high-frequency algorithms were fighting over fractions of a penny, the most significant event in the history of the silver market took place quietly, with a single stroke of a pen inside the Oval Office. On Wednesday, January 14th, 2026, the President of the United States signed a document that officially ends the 50-year war against the price of silver. The document is a proclamation under Section 232 of the Trade Expansion Act. To the casual observer and to the mainstream media, it looks like just another piece of boring bureaucratic paperwork, a trade adjustment, a tariff tweak. But if you actually read the text, if you parse the specific legal language buried in the middle paragraphs, you realize that this is not a trade deal. This is a declaration of economic independence. For the first time in generations, the United States government has admitted the terrifying truth. The low price of critical minerals is not a benefit to the economy. It is a threat to national security. Let's look at the specific language used in the proclamation. The president declared that America's over-reliance on foreign imports of processed critical minerals is a direct threat to the safety of the nation. He didn't say it was an inconvenience. He didn't say it was a market imbalance. He used the word threat. In the language of government, a threat authorizes extraordinary measures. It unlocks powers that are usually reserved for wartime. But the real bombshell, the detail that should make every short seller in the world cover their position immediately, is found in paragraph 13. The proclamation explicitly states, depending on the outcome of such negotiations, I may consider alternative remedies in the future, including minimum import prices for specific types of critical minerals. Minimum import prices. Let that concept sink in. For 50 years, since Nixon closed the gold window in 1971, the unwritten policy of the Federal Reserve and the Treasury has been to suppress the price of precious metals. They wanted gold and silver to be cheap. Why? Because expensive metals signal a weak dollar. Expensive metals signal inflation. So they used the futures markets to cap the price. They used leasing programs to flood the market. They did everything possible to keep the price down. Now, suddenly, the policy has inverted. The government is saying that prices are too low. They are admitting that the volatility and the cheap imports are destroying our ability to produce these minerals domestically. Why would they do this? Why would a government that hates inflation suddenly want higher commodity prices? Because they have finally looked at the supply chain and realized they are trapped. You cannot build a hypersonic missile with a paper contract. You cannot build a solar grid with a derivative. You need physical metal. And you cannot have a domestic mining industry if the price of silver crashes to $20 every time a bank in London decides to short the market. By invoking Section 232, the president is signaling that the era of financialization is over and the era of industrial necessity has begun. And to understand why this pivot is happening right now, we have to peel back the layers of the American war machine and look at the terrifying deficit in the one metal that makes modern warfare possible. To understand why the United States government is suddenly interested in price floors for silver, you have to unlearn everything you have been taught about modern economics. You have to reject the premise that low prices are always good. For the last 40 years, the Federal Reserve and the U.S. Treasury operated on a single overriding principle. A strong dollar means low commodity prices. The logic was seductive in its simplicity. They believed that if they could keep the price of gold, silver, and oil down, they could mask the inflation created by their money printing. They believed that cheap raw materials would act as a permanent stimulus for the consumer economy. If silver is cheap, electronics are cheap. If oil is cheap, gas is cheap. The voter is happy. And for a long time, it worked, or at least it appeared to work. The futures markets in New York, COMEX, and London, LBMA, became the primary tools of this policy. By allowing unlimited paper contracts to be traded against a limited amount of physical metal, they created a mechanism to absorb demand without raising the price. It was the ultimate magic trick. You could print trillions of dollars, but gold and silver wouldn't skyrocket because the paper price said everything was fine. They tell you the market determines the price. The reality is, The derivative determines the perception. But there was a hidden cost to this policy, a cost that was not paid in dollars, but in sovereignty. By suppressing the price of silver to artificial lows, by keeping it pinned at $15, then $20, then $25, the West effectively destroyed its own mining industry. Think about the economics of a mine. It is not a software startup. You cannot build it in a garage. A silver mine takes 10 years to permit. It takes billions of dollars to build. It requires massive amounts of diesel, skilled labor, and specialized equipment. It is one of the riskiest businesses on Earth. You are fighting geology, politics, and gravity. Now put yourself in the shoes of a CEO or an investor. If the price of silver is volatile, if it can crash 50% in a single year because of paper trading in New York, are you going to approve a new mine in a high-cost jurisdiction like Nevada or Idaho? No, the risk is too high. The return is too uncertain. You're not going to spend $1 billion digging a hole in the ground if you think JP Morgan might smash the price below your production cost next week. So what happened? Capital fled. Investors stopped funding American mines. They moved their money into tech stocks. They moved their money into bonds. They moved their money into anything that wasn't a hole in the ground. The result was capital starvation. The Western mining complex atrophied. The skilled labor retired. The equipment rusted. The exploration stopped. We stopped looking for silver because the market told us it was worthless. But while the West was starving its miners, the East was feeding theirs. China took a fundamentally different approach. They viewed mining not as a profit center, but as a strategic imperative. They didn't care if a mine lost money in the short term as long as it secured the metal for the state. They subsidized their production. They lowered environmental standards to speed up extraction. They bought assets all over the world while prices were low. And this brings us to the Great Subsidy. Every time the bullion banks in New York smashed the price of silver, they were creating a discount for Chinese industry. When silver traded at $18, it was a gift to the solar panel manufacturers in Shenzhen. It lowered their input costs. It allowed them to undercut American manufacturers. It allowed them to dominate the global supply chain. The suppression of the silver price was, in effect, a massive wealth transfer from Western investors to Chinese industry. We suppressed the price to save the dollar, and in the process, we lost the physical economy. The Section 232 Proclamation is the admission that this policy was a catastrophic failure. The government has finally realized that cheap silver is a national security threat. You cannot have energy independence if you depend on your adversary for the metal that conducts the energy. You cannot have military superiority if you depend on your adversary for the metal that guides your missiles. To break this dependence, the United States must rebuild its domestic mining capacity. It must reindustrialize. But here's the catch, and this is why the price is about to explode. You cannot rebuild a mining industry at $20 an ounce. You cannot even do it at $50 an ounce. To build a mine in the United States today, with our labor costs, our environmental regulations, and our energy prices, you need a guaranteed price that is much, much higher. You need a price that incentivizes capital to leave the safety of the stock market and enter the danger of the mining sector. And since the free market is broken, the government has decided to fix it. So, how do they do it? How does a government force the price of a global commodity to go up? This is where the legal mechanism of Section 232 comes in. The proclamation mentions minimum import prices. This is a technical term for a very simple concept, a price floor. Think of it as a government-sponsored put option. Or better yet, think of it like the FDIC for your bank account. The government tells you, don't worry about putting your money in the bank. If the bank fails, we will make you whole. Now, apply that to mining. The president is effectively telling the mining industry, go ahead and build the mine. Spend the $1 billion, hire the workers. If the market price falls, we will ensure you are still profitable. It is a promise of stability. It is the United States government saying that they will not allow the banks to smash the price below the cost of production ever again. This fundamentally changes the investment thesis for silver. For the last decade, investing in silver was a bet against the establishment. You were betting that the banks would lose control. You were fighting the Fed. You were fighting the Treasury. It was an uphill battle. You were the underdog. Now, investing in silver is a bet with the establishment. The government wants the price higher. They need the price higher. If silver drops to 90, as it did during the flash crash we discussed, the old logic would say the rally is failing. But the new logic says this volatility is the enemy of the state. Why? because a crash to $90 makes American mines uninvestable compared to Chinese mines. It widens the spread. It hurts the strategic objective. Therefore, the government has a vested interest in stopping the crash. We are moving from a free market to a managed market. In a managed market, the price is not set by supply and demand. It is set to achieve a policy goal. The policy goal is supply security. And the only way to achieve supply security is through high, stable prices that reward production. This is why the current volatility, the drop to $90 while Shanghai is trading at 102, is so critical. This spread is the exact distortion that the Proclamation aims to fix. The arbitrage gap is draining American wealth. Right now, because the price is suppressed in New York, we are effectively selling our silver to China at a discount. We are being strip mined by the arbitrage bots. They buy it cheap in New York, fly it to Shanghai, and sell it high. The metal leaves the West and enters the East. The price floor is the wall that stops the drain. If the U.S. government sets a floor, the arbitrage closes. The metal stays here. The mines get built here. This is the economic pivot. It is the realization that price is not just a number on a screen. Price is a signal. And for 50 years, we sent the wrong signal. We told the world that silver was worthless. Now, we are telling the world that silver is critical. If you want to know what happens when a government treats a metal as a strategic weapon, look at palladium. Russia produces 40% of the world's palladium. A few years ago, when geopolitical tensions rose, the market feared that Russia would restrict exports. They didn't even have to officially ban it. Just the threat, the shift from commodity to strategic asset, caused the price to go vertical. Why? Because palladium is essential for catalytic converters. You cannot build a car without it. The auto industry didn't care about the price, they just needed the metal. Silver is the next palladium. But it is bigger. Palladium is used in one industry, silver is used in every industry. And unlike palladium, the shortage in silver is not just a threat, it is a mathematical certainty. By invoking Section 232, the U.S. has signaled that it views silver the same way Russia views palladium. It is no longer something we trade, it is something we hoard. And when the world's largest economy decides to hoard the world's most conductive metal, $100 is not the ceiling. $100 is the opening bid. We have analyzed the legal text of the proclamation. We have deconstructed the economic failure of the low price doctrine. Now, we must turn our attention to the physical reality of the modern world. We must answer the question, why silver? In the list of critical minerals, lithium, cobalt, rare earths, silver is often the unsung hero. It doesn't always get the headlines. It doesn't always get the subsidies. But without silver, the other minerals are useless. Silver is the ghost in the machine. It is the invisible nervous system of the 21st century economy. The reason President Trump's proclamation is a game changer for silver, even if the word silver is not in the title, is because of physics. Silver is the most conductive element in the known universe. It moves electrons faster and more efficiently than copper, than gold, than anything else. In a world that is digitizing, electrifying, and automating, you cannot engineer around silver. You can try to thrift it. You can try to use less of it. But for high-performance applications, there is no substitute. And the highest performance application on Earth is war. This is where the national security designation becomes terrifyingly real. Consider the Tomahawk cruise missile. It is the backbone of the United States naval strike capability. It relies on a silver-zinc battery to power its guidance systems during flight. Why silver-zinc? Because it has a massive power-to-weight ratio, and it is reliable. You cannot put a cheap lithium battery in a missile that sits in a silo for 10 years and expect it to work. You need silver. Consider the Mk-50 torpedo. Its propulsion system is driven by a chemical reaction involving silver. Consider the F-35 fighter jet. It is a flying supercomputer. Every sensor, every radar array, every communication link relies on silver-coated contacts to ensure the signal does not fail at Mach 2. The United States military-industrial complex consumes millions of ounces of silver every year. But here is the critical vulnerability that the Section 232 proclamation exposes. The Pentagon does not have a strategic stockpile. They sold it. Throughout the 1990s and the early 2000s, the U.S. government sold off its strategic silver reserves to mint coins and suppress the budget deficit. They assumed that the global market would always provide. They assumed that if they needed silver for a war, they could just buy it from the COMEX. But as we saw in the previous reports, the COMEX is empty, the mint is closed, and the supply chain runs through China. This is the nightmare scenario for the Department of Defense. Imagine a conflict breaks out in the Pacific. The U.S. Navy needs to ramp up production of missiles. They call Raytheon. Raytheon calls their suppliers. And the suppliers say, sorry, we can't get the silver. The Chinese bought it all. This is why the proclamation explicitly mentions foreign imports of processed critical minerals as a direct threat. It isn't just about money, it is about the ability to pull the trigger. By declaring these supply chains a threat, the president is effectively nationalizing the demand side of the equation. He is saying that the military's need for silver overrides the market's desire for a low price. This introduces a new kind of buyer to the market, the price inelastic buyer. We talked about Samsung being inelastic, but the Pentagon is the ultimate inelastic buyer. If the price of silver goes to $500 an ounce, does the Air Force stop building jets? No. They print the money, they pay the price. They do not care about the cost, they care about the capability. This puts a rocket booster under the price floor. The price floor we discussed in Section 2 guarantees that the price won't fall below the cost of production. But the military demand guarantees that the price will rise to whatever level is necessary to secure the metal. And let's look at the green energy angle, which is the other side of the national security coin. Energy independence is national security. The U.S. grid is moving towards solar. A standard solar panel uses roughly 20 grams of silver. The new high-efficiency TOPCon panels use even more. The Biden administration pushed for solar. The Trump administration pushes for energy dominance. Both roads lead to silver. If you want to reshoring solar manufacturing, which is a stated goal of the proclamation, you need millions of ounces of silver available domestically. You cannot build American-made solar panels if you have to beg China for the silver paste. This creates a civilian-military competition for the metal. Tesla needs it for EVs. First Solar needs it for panels. Raytheon needs it for missiles. They are all fighting for the same shrinking pie. And up until yesterday, they were all hoping for lower prices. The Section 232 order ends that hope. It tells them, the era of cheap imports is over. You must build domestic capacity, and to do that, you must pay a premium. This is why the volatility we saw today, the drop to 90s, is so dangerous to the government's plan. If the price crashes, the investment in domestic mining stops. If the investment stops, the dependence on China deepens. If the dependence deepens, national security is compromised. Therefore, the government must fight the crash. They are not intervening to help the speculator. They are intervening to save the supply chain. For the investor, this means you have the most powerful ally in the world. You're no longer just long silver. You are long the United States defense strategy. The unsung hero is finally moving from the back of the cupboard to the front of the Situation Room. But there is a timeline attached to this. The government moves slowly, but executive orders have deadlines. The proclamation sets a clock ticking. 180 days, July 13th, 2026. That is the date when the negotiations conclude. That is the date when the price floors and tariffs could officially kick in. Between now and July 13th, we are in a transition zone. The old world of manipulation is dying, but the new world of price supports hasn't fully formed yet. This transition zone is where the opportunity lies. We have arrived at the conclusion. If you have been with me through this geopolitical assessment, you now understand the full scope of the paradigm shift. You understand the legal power of the Section 232 proclamation. You understand the economic necessity of the price floor to rebuild domestic mining. And you understand the military imperative that makes silver a matter of national survival. The evidence is overwhelming. We are not just looking at a market cycle. We are looking at a changing of the guard. The era of the central banker, whose goal was to suppress the price to hide inflation, is ending. The era of the strategic planner, whose goal is to raise the price to secure supply, has begun. But knowing the why is not enough. You need to understand the when. Government policy does not move at the speed of high-frequency trading. It moves at the speed of bureaucracy. But when it finally arrives, it hits with the force of a tsunami. The proclamation signed by President Trump sets a very specific clock ticking. It outlines a negotiation period with trading partners to secure these critical mineral supply chains. The timeline is 180 days. If we count forward from the signing date of January 14th, 2026, we arrive at a critical date, July 13th, 2026. This is the checkpoint. This is the date by which the new trade deals must be finalized, or the unilateral measures, the tariffs, the quotas, and the official price floors could officially kick in. For the uneducated investor, July seems like a lifetime away. They will look at the volatility today, the drop to $90, and they will get distracted. They will think they have time to wait. But the smart money does not wait for the deadline. The smart money front runs the deadline. In financial markets, price moves in anticipation of an event, not after the event. If the market knows that on July the 13th, the U.S. government is going to effectively guarantee a floor price for silver, let Orator S hypothetically say that floor is $120 to make mining profitable, the market will not wait until July to trade at $120. It will go there now. Why? Because no rational seller is going to part with their metal for $90 today if they know the government is guaranteeing $120 in 6 months. Sellers will withdraw supply. Buyers will rush to front-run the mandate. The price adjusts instantaneously to the future reality. So, what is the strategy for the individual investor in this transition zone? 1. Buy the gap. We are currently in the gap between the death of the suppression scheme and the birth of the support scheme. This gap is characterized by extreme volatility and disinformation. Your strategy must be strategic accumulation. You are getting a discount on a national security asset. 2. Ignore the media noise. The banks, the entities that have profited from suppression for 50 years, will not go quietly. They will use their remaining paper ammunition to try and discredit the move. Ignore the headlines. Watch the safety net. 3. Recognize the asymmetry. Think of the price floor as an insurance policy. The government has just signaled that they cannot afford for silver to crash. If it crashes, the mines close. If the mines close, the missiles don't fly. Therefore, the downside risk has been transferred from you, the investor, to the United States Treasury. The risk is capped, but the reward is open-ended. I want to leave you with this thought. We are watching a collision between two irresistible forces, the deflationary force of the debt-laden banking system and the inflationary force of the reindustrializing state. History tells us that in times of war and crisis, the state always wins. The banks will be brought to heel, the price will be reset. The national security pivot is the final piece of the puzzle. We have the physical shortage, we have the bank war, and now we have the political guarantee. The stool has 3 legs. It is stable. The bull market is no longer speculation. It is a policy objective. July 13th, 2026 is the deadline on the paper. But the deadline in the market is now. Do not wait for the official announcement. By the time they announce it, the price will already be out of reach. Use this volatility. Use the confusion. Secure your position while the paper price is still detached from the strategic value. The United States government has just drafted silver into the service of the nation. It is no longer just a coin in your pocket. It is a component of American sovereignty. And sovereignty is expensive. If you want to stay ahead of the policy curve, if you want to join the few who see the roadmap before the road is built, then subscribe now. Turn on notifications, because the next time I speak to you, we might be living in a very different world. Hold your metal, watch the countdown, and prepare for the reset.